Moving averages are like the cool kids in the world of technical analysis. They smooth out price data, creating a trend-following indicator. Basically, a moving average tells you the average price over a certain period. Think of it like this. It's the stock's batting average. There are three main types of moving averages: SMA, EMA, and WMA. Each one calculates the average a little differently. This leads to different insights. Let's break down each type and see what makes them special. Want to be a better trader? Moving averages are your secret weapon. They help you understand the trend and identify potential buy and sell signals. So buckle up, because we're about to dive deep into the world of SMAs, EMAs, and WMAs. The simple moving average, or SMA, is the simplest of the bunch. It's like the vanilla ice cream of moving averages, classic and reliable. The SMA is calculated by adding up the closing prices of an asset over a specific number of periods, then dividing the sum by the number of periods. Here's the formula. SMA equals the sum of closing prices over in periods divided by n. Let's say we want to calculate the 10-day SMA of a stock. We'd add up the closing prices of the last 10 days and then divide by 10. Easy peasy. The pros? The SMA is simple to understand and calculate. It provides a good representation of the overall trend. The cons? It gives equal weight to all periods, so older data can skew the average. Use cases? The SMA is great for identifying the direction of the trend. You can also use it to identify support and resistance levels. The Exponential Moving Average, or EMA, is like the SMA's cooler, more sophisticated cousin. It gives more weight to recent prices, making it more responsive to price changes. The formula for the EMA is a bit more complex, but your charting software will do the heavy lifting for you. Here's the gist. EMA equals the closing price times the smoothing factor, plus the previous EMA times 1 minus the smoothing factor. The smoothing factor determines how much weight is given to recent prices. A higher smoothing factor means more weight is given to recent prices. The EMA is a great tool for identifying short-term trends and reversals. It's also useful for confirming breakouts and breakdowns. Section 4. Weighing in on the WMA. The weighted moving average, or WMA, is like the EMA, but with even more emphasis on recent prices. It assigns a progressively decreasing weight to older data points. This makes it the most responsive of the three moving averages. The formula for the WMA is a bit more involved, but again, your charting software will do the calculations for you. The WMA is a great tool for traders who need to be on top of the market's every move. Section 5. Comparing the averages and their applications. So, which moving average is right for you? It depends on your trading style and time horizon. Feature SMA, EMA, WMA. Say. Calculation, simplest, more complex. Most complex weighting, equal weight to all periods, more weight to recent periods, progressively decreasing weight to older periods. Responsiveness, least responsive, more responsive, most responsive, best for identifying long-term trends. Identifying short-term trends and reversals. Identifying very short-term trends and reversals. If you're a long-term investor, the SMA might be your best bet. If you're a short-term trader, the EMA or WMA might be more suitable. Ultimately, the best way to find out which moving average works best for you is to experiment and see what suits your trading style.